Okay, so since all of you can hear me as well as Ritesh, let's start the webinar. And we will see. Ritesh, you can hear me, right? Yeah, you can
Hello.
just like nod your head if you can hear me. I cannot hear anyone. So
Ritesh, you can start now.
Hello, Nitish.
a very good morning to all of you. Thank you so much for joining the next webinar in our IIQF Expert Series webinar. Today's webinar topic is webinar on central bank digital currency. And to take you through us in this webinar, we have with us Ritesh Chandra. We are very glad to have him with us. Thanks, Ritesh, for joining in.
Very good morning to all of you.
So just to give a brief background about Ritesh. Ritesh is a banker with more than 14 years of experience in credit and risk management, and currently works as president of a leading private sector bank. And prior to that, he was in IT consulting and had worked in a variety of roles in India, China, and Canada. He's very passionate about teaching, and he has been conducting workshops and training programs for the last 6 years. His areas of interest are credit risk, quantitative finance, and statistical learning. And digital currency, cryptocurrency, blockchain is also some of the areas he's currently doing a lot of research on. So Ritesh is a PGDM from IIM Calcutta, and he's also a BTech from IIT Kanpur. He's a member of the Board of Studies at IMT CDL Ghaziabad in the area of financial management. So we'll hand over the session to Ritesh to start. But before handing over the session, I would just like to lay down the basic of how we would go about in today's session. So today's session is will be about, as you all know, it's about 1.5 hours, out of which we would hear on the topic of the day for about an hour, and then we would have the Q&A session. Before the Q&A session, we would give a brief introduction about ourselves as well. But we would like the webinar to be as interactive as possible. So please feel free to type all your questions in the chat window. We would be happy to take up all the questions that you would be putting up. So please feel free. And also one request, those who have put up their questions earlier since I restarted the session, so I would request you to put your questions once again in the chat window. So let's start the session. Over to you, Ritesh.
Can you make me the presenter? Hello. Okay. So can you see my screen, Nitish? Hello. Nitish, can you see my screen?
We can see your screen.
Okay. Okay. So a very warm welcome to all of you. And the topic for today's discussion is central bank digital currency, or CBDC. In fact, as you all know, this term has been appearing very, very frequently in both financial and mainstream media these days. And this entire concept of central bank digital currency, it has been discussed in academic circles, in financial circles since 2014, but it really became popular only after Facebook announced the launch of their digital currency by the name of Libra. In fact, finally the plan was shelved, but Facebook announced it in 2019, June 2019, and this is just to show you a graphical chart. as to how the Google search for central bank digital currency just jumped after Facebook announced the launch of Libra. And that's when all the central banks became very, very interested in CBDC, because now there was a global multinational, someone with the scale of Facebook, planning to launch a digital currency which could be used for cross-border transactions as well. So all the central banks became aware of this, that someone is trying to do that, and this whole concept of CBDC or central bank digital currency became much more popular. In fact, there was a survey conducted by the Bank for International Settlement, BIS, in 2021, which said that almost 86% of the central banks were doing some kind of research for launching a potential CBDC, and around 60% of them were already experimenting with one technology or the other, and almost 15 to 20% of the central banks, they were already in the stage of deploying a pilot project. So that's the speed at which this has grown. Okay. When it comes to India, very recently on 1st of November 2022, the Reserve Bank of India, they started a pilot program of digital rupee in the wholesale segment. And the use case for this digital rupee is for settlement of secondary market transactions in government securities. And RBI has also announced that they will launch the first pilot for a retail digital rupee. So what is a retail digital rupee and what is a wholesale digital rupee or digital currency? That's also something that I will talk about. So RBI has announced that they will launch a retail version, a pilot project within a month's time in select locations and for certain closed user groups, which will include both customers and merchants. So CBDC is not something which is in the realm of academic discussions and technological possibilities. It is becoming a reality. Okay. Now, if you ask what a CBDC is, you can think of it as a digital sovereign currency which has been issued by the country's central bank. So it is central bank money, and it's a direct liability of the central bank of the country. So in case of India, it will be the direct liability of RBI. The Bank for International Settlement, or BIS, they define CBDC as a purely digital banknote which individuals can use to make payments, to do shopping. That is what retail CBDC is. And there's another version which is used by financial institutions to settle transactions or to settle trades in financial markets. And that is what is called a wholesale version of the CBDC. So it depends on who is the end user. For wholesale version, the end users are the financial institutions. And for retail CBDC version, the retail customer is the end user. Now, one question which can come to the mind of a lot of people is, why do we need a new digital currency in the first place? I already have money in my bank account. I'm able to do NEFT. I'm able to do RTGS. I'm able to do UPI, Google Pay, Paytm. So I am able to do digital currency, digital transactions, digital payments, and all this is happening at a fairly fast pace. The payment through UPI is literally real time. So the question one may ask is, oh, why do we need a digital money and launch a new platform for that when already I have digital currency in my bank account? Well, to answer that question, it might sound slightly counterintuitive, but the credit balance that you have in your bank account, that is not central bank money. That is not the legal tender which is authorized by the government. Okay, it sounds very counterintuitive. Let's look at it in some more detail. It's important to understand what are the different forms of money that are circulating in the country. The simplest form of money is the cash, banknotes and the metal coins, which are issued by the central bank, which is RBI in our case. That is the liability of the central bank of the country. But when it comes to most of the payments these days, especially the large payments, they are done electronically. Now the question is, who creates this electronic money or the computer money? See, For electronic transactions, you are simply moving some numbers from one account to another account. Okay, so one question which you may have in mind is who created this electronic money or computer money, and the answer is again RBI. So RBI or the central bank can create electronic money, and how do they do that? They do that by giving a loan to their customers. So whenever RBI allows its customers or extends credit to its customers in form of say an overdraft facility, or when the RBI purchases assets like treasury securities or foreign exchange from its customers, or even when RBI credits or even when the RBI pays the salary of its staff, they are creating electronic money. Now, the only issue here is that RBI does not, or the central bank does not directly deal with general public. Their customers are only commercial banks and financial institutions. So they make those loans to financial institutions, and they create the electronic version of the central bank money, which we call the central bank reserve. So these two versions of money, the physical banknotes, the physical coins, and the central bank reserves, they are what you call the central bank money or the monetary base of the country. Okay, when it comes to settlement of transactions, general public always has to interact through banks. They don't have directly access to RBI. So when it comes to settlement of transactions between banks, there are two options. Either the banks settle those transactions bilaterally amongst themselves. Each bank has an account with every other bank, but that process is far, far more cumbersome. So what banks do, they all hold an account with the RBI and they settle transactions amongst themselves through that central bank account. And how does that settlement take place? By shifting the central bank reserves from the account of say an SBI to the account of say an HDFC. So these central bank reserves, that means the balance which the commercial bank is holding with the RBI, that is an electronic money, that is central bank money, and it is risk free. Why? Because it has been created under the authority of the sovereign government. The only catch is general public, you and me, do not have access to this. Only commercial banks have access to the central bank reserves. Now, there is a third kind of money which has not been created by the government of India, which has not been created by the RBI. This third type of money is what you and I are holding in our bank accounts. And in banking terminology, it is called bank deposit or demand deposit. In technical terms, this is simply a number which is there in a computer system of your bank. In accounting terms, it is the liability of your bank towards you. Okay. Now it's very important to understand that this is not a deposit in a traditional sense. In a traditional sense, what will happen is, suppose you have some gold jewelry, you go to a Muthoot Finance, you keep it there, or you have some gold jewelry, which you go and keep in your bank safety deposit locker. So it is just lying there. But in this case, your money is not lying in some account and earmarked to you. Your money is being used by the bank as they wish to use it. And what the bank in turn has done, they are recording a liability towards you to make a payment to you or to make a payment on your behalf as and when you require. And that is what is the credit balance in your account. Okay, so the money that you have in your bank account is just a record of what the bank owes you. Remember, this is not the legal tender. This is not a sovereign issued money. The sovereign issued money is only the banknotes or the central bank reserves. But over a period of time, the way our banking system and payment systems have evolved, the bank deposits have become as good as real money. Okay, in fact, you can even convert that digital money which is lying in your bank account into physical notes, but only till the time that the bank is solvent. If there is a run on the bank, then there is a possibility that the bank may not allow you to withdraw that cash in physical banknotes. Now that is something which often happens with cooperative banks in our country. So you all must have seen the case of the PMC bank, where the depositors' money got stuck. So what happens is, to ensure the stability of the financial system, the central bank becomes the lender of last resort, and it says that tomorrow if there is a run on the bank, then I will step in and I will ensure that everyone is able to liquidate their deposits into banknotes, so that there is no systemic financial crisis. However, in strict technical terms, the money that is lying in your bank account is not the legal tender of the country. This is what we call commercial bank money. Okay. Now you may ask, how do commercial banks create money on their own? Very, very similar to how the RBI creates money in the first place. Whenever the commercial bank gives you a loan, what do? They put that money that they have loaned to you in your current account or saving account, and that's how money gets created. So throughout the economy, the money is getting created by extending loans through credit. That is how money actually gets created in the economy, and it's the commercial bank money that the commercial banks are lending to general public that in fact constitutes bulk of the money that is circulating in the system. Okay, so it's important to understand this point, that the money in your bank account is not central bank money. So CBDC, on the other hand, will be a pure central bank money, just like the physical banknote or the central bank reserve. It will be a liability on the books of the RBI. It will be a legal tender. It will not be a commercial bank's liability. So you don't have to rely upon the solvency or liquidity of your bank, or say your wallet service provider like a Paytm. You don't have to rely on their solvency and liquidity to maintain your balance. Okay, I hope that that clears the point. Now, once you understand this point, the next question we often have in mind is, but why do central banks want a CBDC in the first place? Okay, see, what is happening is, over the last 10 or 12 years, with the surge of digital payments in the economy and the arrival of cryptocurrency on the scene, what is happening is that the control over monetary policy and the control over money supply is shifting away from the central banks and getting more and more into the hands of private sector players. And central banks want to prevent that situation. They want to maintain their control on the money supply of the country, and that is one of the biggest reasons why they want a CBDC in the first place. Having said that, there are several advantages which have been identified vis-a-vis a central bank digital currency. First of all, it gives the central bank, the monetary authority, and the government a much better visibility over economic activity of the country. So today, if as a monetary authority or as a policy maker, you are trying to understand what scale of economic activity is happening in a particular sector or in, say, some region, then you have to rely on some general estimates or some outdated data, because it takes a lot of time to gather data from the system. Then you clean that data, you analyze it, and you present it. On the other hand, if you have an economy that is operating on a CBDC, it would provide real-time visibility to policymakers in terms of, say, what economic activity is happening in the iron and steel sector, or in the restaurant sector, or in a particular state or region of the country. Of course, here the assumption is that the entire country or the entire economy has gone completely digital, but that's a possibility. The only challenge here is too much visibility into the transactions given to the government always has privacy concerns. There is always this concern that people's privacy will be violated, and the government or the government authorities may end up harassing people. So that's a huge concern, especially in areas like markets like Europe, with regard to a digital currency. The second benefit is with regard to curtailing black economy and tax evasion. Because cash transactions are not easily traceable, and that is why if someone wants to underreport revenues because they want to pay lower taxes, they essentially resort to cash transactions, and this is a serious problem around the world. In fact, some of the World Bank estimates show that the average size, the weighted average size of the shadow economy that we call the black economy as a percentage of the official GDP is very, very high in certain regions of the world. In some parts of Africa, the shadow economy or the black economy or the cash economy constitutes around 40% of the total GDP. In parts of Europe, especially Eastern Europe, in Central Asian countries, again, this is close to 35 to 40%. And even in some of the high income countries, the OECD countries, the developed countries, some estimates show that the black economy may be as large as 10 to 12% of the entire GDP. So CBDC can be used to tackle that problem. Next advantage would be in tackling money laundering and corruption. Once again, cash is the preferred mode of payment here because cash is not traceable. It's a private means of payment. That is why criminals, drug dealers, politicians, illicit businesses, or anyone who is engaging in a criminal or illicit activity, they prefer to operate in cash. But if the economy becomes CBDC based, then corruption using cash becomes almost impossible because all transactions are now traceable. Corruption, of course, will always be there. It might take a different form, but corruption in the form of money will become much more difficult. Now, again, this is a serious problem. Some of the international estimates show that money laundering accounts for like 2 to 5% of the global GDP. That is almost somewhere between $1 to $2 trillion every year that is getting laundered. So CBDC can be used to address that problem as well. There are many other policy benefits in terms of what we call a programmable money, because it's a digital money, it's an electronic money, it's programmable. And how do you do that? See, essentially the CBDC will run on a blockchain or a similar technology. If not blockchain, it would be some kind of a distributed ledger technology on which the CBDC will run. Now, technologically, blockchain allows you to do a lot of things with digital money that is considered impossible today. What those things could be? Say, if the central bank wants people to spend in the economy, they want to kickstart the economy, and they want that people don't put the money in their bank account, they should instead go ahead and spend it in the economy in purchasing goods and services. There is the concept of negative interest rate these days, especially in some of the countries in Northern Europe. We have seen negative interest rate being applied, wherein if you put money in your bank account, the bank does not give you interest. Rather, you have to pay interest to the bank. That's what negative interest rate is. Now, with a CBDC, the central bank can directly apply a negative interest rate, something which is not possible with cash banknotes today. Of course, with your bank account they can, but the money that you are holding in cash, they cannot directly impose a negative interest rate. Similarly, they could create different variants of the electronic currency, and some of the variants could be such that if you don't spend it in a certain time interval, it will simply expire. Why would such money be used? Suppose the government is trying to again provide financial stimulus and they want to kickstart the economy. This is something that we have seen after the COVID-19 pandemic, when the government gave a lot of cash support to people directly in developed countries. But what people did with that money, they did not spend it on real goods and services. Instead, that money found its way into the financial markets, into the stock market. Okay, so to align people to those monetary guidelines or to monetary policy objectives, CBDC can be a huge game changer. Similarly, today you have around 1 billion people around the world who are unbanked. one of the biggest reasons for that is those people do not have proper identifications, and therefore they will not be compliant with the bank's KYC and AML norms. But everyone can host a digital wallet on their smartphone. So for financial inclusion, again, a central bank digital currency can be a huge benefit. And finally, CBDC can be used to provide an alternative to existing payment systems. Presently, in countries like India, there is a huge market concentration in our UPI system. So if you look at the UPI system, two of the players, Google Pay and Phone Pay, they together account for 82% of all the UPI transactions that are happening in the country. That's a huge concentration. CBDC can provide an alternative to those systems. So these are the various advantages or various use cases that CBDC can be used to address. Another thing which often comes to the mind is how is this CBDC different from a cryptocurrency like Bitcoin? The primary difference is any crypto asset or Bitcoin for that matter, they are privately issued. They have not been issued by a central bank. And the value proposition of a cryptocurrency is decentralization and disintermediation of financial institutions. The very idea that crypto came into being was because you want to have a peer-to-peer transaction system which does not need to go through banks or financial institutions. So crypto assets, they offer a direct peer-to-peer transactional capability that does not require a financial institution in the middle. Crypto assets are not a liability on any financial institution's balance sheet. And unlike a CBDC, crypto, a Bitcoin, it is not backed by the support of any sovereign government or any centralized authority. And because they are not on anyone's balance sheet, okay, there is no central issuer on whom you have a claim for your crypto assets. Because of this, you are exposed to a huge price risk when it comes to crypto assets. Bitcoins are susceptible to huge prices fluctuations. You can see this, how the Bitcoin's price has fluctuated vis-a-vis US dollar over the years. You can see this. This is somewhere like the beginning part is 2017 beginning. This was like less than $10,000 per USD. And then at the peak, it has reached almost 70,000, and now it has again come to 20,000. Now, if the crypto asset has such large price fluctuations, that means its purchasing power is fluctuating so wildly, there is so much of volatility, its value is no longer predictable, what its value will be in the future, and therefore people will not use it as a medium of exchange. You don't want to use something as money whose value can depreciate by say 10-20% overnight. That is the problem with crypto. To address that problem, some people have tried to issue a more stable type of crypto asset. These are what we call stable coins. In fact, that Facebook's Libra is supposed to be a kind of stable coin. What happens in the stable coin is you want to give a certain stability to the value of the stable coin, even though no central authority is backing it. So what you do, you link the value of the crypto asset to some fiat currency, say US dollars, or a basket of currency, say a US dollar, euro, and others, or even a commodity like gold or oil. This is very similar to what happened in the old days when the gold standard was in place. So for example, in US, till 1935, the gold standard was in place where the US Fed was restricted to issue the amount of dollars vis-a-vis the gold holdings that they had. So every dollar that they issued, it had to be backed by a certain amount of gold in the US Fed's reserve. Okay, of course, US left the gold standard later on. That's a different issue, but that's what the stable coin tries to achieve in the digital world. A CBDC, on the other hand, because it is backed by the authority of the sovereign government and the central bank, it is as safe as cash. So you don't have to worry about very wide fluctuations in its value. So that's how CBDC compares with the general universe of cryptocurrencies. Now, essentially, people are talking about two kinds of CBDC. A wholesale CBDC, again, as I mentioned earlier, it's a digital asset which will be issued by the central bank, but it will be used for settling transactions amongst banks and financial institutions. And then you have the retail CBDC. Here, the end user will be public, merchants, companies. Okay, so while work has been going on for both, going on with regard to both of them, it's retail CBDC that uh, is supposed to be of more significance, because retail CBDC can be used by the general public. It can be used as a substitute for cash, physical cash, and it can also be used to settle cross-border transactions in a very, very efficient and timely manner. So retail CBDC is what I will talk about more. See, uh, when it comes to retail CBDC, the thing is, what are the various advantages that you can get by going to a retail CBDC? So these are some of the advantages. One thing is that payments will become much more efficient. You can check on money laundering. There could be a better transmission of monetary policy. This is again very, very important. What has been happening since the financial crisis of 2007 is the central banks have pumped in huge amounts of money into the financial system to kickstart the economy. That's what they did in the name of quantitative easing after 2007 financial crisis, when European governments, European central banks, and the US central bank, they pumped in billions of dollars and euros into banks. What they did, they bought the assets of the banks and they gave them money. And the idea was that the banks in turn would lend to customers, and customers will spend that money in the economy, and the economic growth will be achieved. However, that did not happen. The reason is, when banks got that money, instead of lending it onwards, they just kept it in their balance sheet and kept earning interest on them from the central bank itself. So they parked it with the central bank, and even though a very large quantitative easing program was launched, it did not have a very good effect. This is something very similar we have seen in Japan. Since the real estate crisis hit Japan in 1990s, the Bank of Japan has had a very, very liberal monetary policy. But if you look at how Japan as an economy has behaved over the last 15, 20, or 25 years, Japanese economy has actually seen a deflation, in the sense that the real prices have actually declined instead of increasing. And that is why even today, when the US Fed and the other central banks, they are raising their interest rates, the policy rate of the Bank of Japan is still 0%, because they want to kickstart the economy. The inflation still is a problem which they want to have in Japan, something which they have been trying to bring into the Japanese system. So it will strengthen monetary policy by because the central bank can directly do things with the digital currency. Then, of course, the financial inclusion is there, benefit, financial stability benefit is there, because people have a more bankable mechanism compared to commercial banks. But at the same time, this retail CBDC can have a lot of concerns and disadvantages as well. The biggest disadvantage which comes to my mind is how it will impact the business of banks. So there will be what we call the disintermediation of banks, because it is a central bank issued money issued by the sovereign. So it is relatively risk free compared to commercial bank money. As I told you, if tomorrow your commercial bank becomes insolvent, the deposit that you are holding with them, you cannot access it. Even if you have deposit insurance, what will happen? The deposit insurance in India today guarantees only up to 5 lakhs. And it's not that you will get that immediately. Getting that money out of the deposit insurance will take time. And anything that you have over and above that amount is anyways gone. You become a general unsecured creditor when the bank goes into liquidation. So what can happen is, because it's a true risk-free asset issued by the central bank, it may actually precipitate a bank run, where in the times of crisis, people en masse, depositors as a whole will try to convert their bank deposit into CBDC, and it can accelerate banking crisis. That is a huge downside or concern with a retail CBDC. Also, it will result in increased funding cost for the banks, because a part of the deposits will be moved into CBDC, so their funding cost will increase and their revenues will be hit, or in turn, banks will start charging more for their services. So that's a downside. Cybersecurity is a huge concern. So any retail CBDC could be a potential target for hackers. And then you have concerns around data privacy, of how you prevent a scenario where the government authorities do not start harassing the common people, or the government authorities, you don't want to give them too much of control or oversight over your daily lives and daily transactions. So that's the downside. Now, when it comes to design of the retail CBDC, there are essentially two design considerations that have been doing the round. One which is token or value based, and one which is account or what we call register based. Okay. Finally, I think whatever design will be there, it will be a mix of the two, but it's important to understand what their individual differences are. See, when it comes to a token based design, the digital currency or CBDC will be a token that will be stored in your digital wallet. This will be something like how you store a physical banknote in your wallet. Similarly, you will be holding a digital banknote in your digital wallet. What the currency would be? The currency would be simply be a token. That means something which has value, and it can be directly transacted by owners between themselves. Now, in a token-based design, the focus is on the token object. It is not on the holder's identity. So to validate a transaction in a token-based model, I simply need to have some digital money in my bank, in my wallet. I can transfer it to whomever I wish to. There would be no one else involved. Okay, so that design will offer greater anonymity, greater privacy, and there will be much less user identity related validation requirements. So you can think of this as a banknote, but in a digital format for all practical purposes. But the reality is, very few central banks are going to implement a purely token-based system. The argument is very similar to why central banks do not want too much of physical cash in the economy, because they are not able to trace that cash. Similarly, they don't want to have a digital system in which they are not able to trace the identity of the people who are doing the transactions amongst themselves. So a pure token-based system is something which I don't think will ever be implemented. Of course, there are several benefits for a pure token-based model. If the central bank wants to design a digital currency which is widely accessible, like cash, where even foreigners, foreign citizens, and foreign entities can come and transact using your digital currency, then of course a token-based system is much more preferable. Similarly, if user privacy is the primary objective, then a token-based system is much more preferable. Okay, so these days, for example, in countries like China, one of the policy objectives is also to make the digital yuan the preferred currency for global transactions. They want to break the monopoly of US dollars. So there, a token-based yuan or a digital yuan, which anyone, no matter which country he or she is a resident of, can transact with, that would be a better solution. Also, if you have a token-based model, then you can also make the transactions offline to a certain extent, which will be very useful in those areas where internet connectivity or communication technology still continues to be a challenge. So for the purpose of financial inclusion, a token-based model would be preferable, but it will have a lot of downsides. The first downside would be that if you have a universally accessible token, a central bank guaranteed digital currency where you don't need any identity requirements, then it can be used for all kinds of illicit activity. You don't have any control in terms of know your customer, KYC norms, anti-money laundering norms. As a result, central banks will not be very comfortable with a anonymous token based retail digital currency model. Okay. The other design consideration is what we call an account based design. This is also called register based design. What happens here is the CBDC is available only in the form of an account which is maintained in some kind of a central register by the central bank itself or by an intermediary. You can think of the account based system in the sense, suppose you have a traditional bank account where you have a debit card, but you can never use that debit card to withdraw physical banknotes. So for all intent and purposes, you only have a account-based transaction that you can do. Now, while the account-based model has again many benefits, there are some limitations also. It can only operate online or with internet access, and so for financial inclusion purposes, that will be a challenge. And what will happen in the real world is, if you have the account or the register-based design, then it will not be directly issued by the central bank. The central bank will not want a system where all the individual customers in the country, they come and open an account with the central bank, and the central bank has to do their KYC and compliance. It will be done through the traditional financial intermediaries or banks. So the ideal form or the ideal design of the retail CBDC will be some kind of a mix between token-based and account-based models, like what we have today. Today you have physical banknotes which are token-based. It has a value. No one knows whom you have given it to. That's the benefit of physical banknote. And you also have the account-based model, which is your bank account, wherein the bank does the KYC and it can be traced as to whom you have transferred your money to or from whom you have received that money. Okay, so what will happen in the digital world also will be that people will want a retail CBDC, some account-based system that they will hold with a bank, and at the same time there will be some token-based feature also that they can use for small ticket transactions. So it will be a mix of the token based design and the account based design. So that is one important thing. And finally, what will be the architecture the central bank will use to implement this CBDC? There are 5 architectures that people have proposed: a decentralized, a direct, a synthetic, a 2-tiered intermediate approach, and a platform or a hybrid approach. The last two, the 2-tiered intermediate approach and the platform or the hybrid approach, they are what I think will be implemented most probably. The first 3, let's not get into that because there is a very low probability that they will ever be implemented. The central bank won't do that. The most likely approach that people have been talking right now is the 2-tiered or the intermediated approach. So this will be a CBDC, which will be a claim on the central bank, but it will be issued to the general public only through commercial banks or through regulated third parties who will maintain an account with the central bank. This one, okay? Let me just show this to you. This one. Now, so in a 2-tier system, what will happen is only the central bank will have the authority to issue and redeem the CBDC, and the commercial banks can only obtain or redeem the CBDC by debiting or crediting their account with the central bank. This is very similar to the existing 2-tier structure, wherein commercial banks have their account with the central bank and the public deals through the banks themselves. Okay. Now, in such a model, the central bank will need to build a platform or a ledger wherein this issuance will happen. But what will happen here is, in this model, the central bank will only record the wholesale transactions that is happening between the individual banks. So that ledger will own the ledger with the central bank will only record the transactions between the individual banks, that is the wholesale level transactions, and the commercial banks or the payment service providers will in turn maintain the more granular ledger, which will record the individual transactions amongst individuals and general public. Okay. On the other hand, if you go to the platform or the hybrid approach, There, the core ledger itself will be with the central bank, and the central bank will keep a granular record of all transactions that is happening between the public. Okay, so in this two-tier approach, the central bank will not record the retail transactions. They will only record the wholesale balances, and the detailed record of the retail transactions will be maintained by the regulated intermediary, which could be a payment service provider or a commercial bank. Okay, there are again many benefits of this model. First of all, this model is something which we are already working with, so this everyone is familiar to this model. It's like going ahead with the status quo, something which is already working for us. Just with the fact is there are no longer any physical notes, everything is happening in the digital domain only. Okay, this can also address the privacy concerns to some level, because the central bank will not have visibility into the retail level transactions. So from a privacy perspective, this is better. Also, from a tech perspective, because the central bank will only have the wholesale ledger, and the retail ledger will be available with the individual banks. So the tech endeavor, even though it still will be a huge tech endeavor, but it will be relatively easier. And from a cybersecurity perspective also, this is a better approach, because all the data is not there in a single centralized ledger. The granular data is spread across the commercial bank's ledger, and it will be difficult to hack everything at the same time. Okay. Nonetheless, even implementing this will be a huge technological endeavor, so that issue remains. Some of the examples of this two-tiered intermediate approach already, some of the East Caribbean countries have launched this currency called DXCD, and in Sweden they have launched the e-krona in 2021. And most of the people and most of the literature, if you read, people believe that this tiered approach is what will finally happen, because whenever central banks decide to launch a full-fledged retail CBDC, okay, primarily because this is a much better approach in terms of ensuring user data privacy, especially in countries like Europe, where data privacy is supposed to be the primary consideration whenever the central bank or the ECB, European Central Bank, they decide to launch a digital euro. Okay. The only downside of this is the central bank will not get a full picture of the economy, which is the purpose of the digital currency in the first place, because they will not have access to granular retail data. On the other hand, in the platform approach, what is happening is here the central bank is also recording the retail transactions on their main ledger. In such a model, the private sector or the commercial banks or the payment service providers, they will onboard all the customers, they will enforce the AML and the KYC regulations, and they will be doing the due diligence, and they will be conducting all the retail payments in real time. But it will be the central bank ledger, the core ledger, which will record all the balances, both wholesale and retail balances, and that will allow the central bank to have a complete visibility of the economic system, the financial system. And the central bank can also act as a backstop to the payment system, in the sense that in this approach, tomorrow if some commercial bank fails, or say some big payment service provider fails, even then the central bank will know the exact detail of what balances each individual customer was holding, and they can compensate them. So the overall payment systems stability or resilience will be guaranteed. Whereas in the two-tiered approach, if some big payment service provider or the big commercial bank fails, the central bank will not have full knowledge of who owned what, and that could be an issue of reconciliation. Okay. So again, in Sweden, they have been tinkering with this. They have been experimenting with this platform approach. In 2020, there was a discussion paper by Bank of England, where Bank of England has also proposed a platform or a hybrid approach towards issuing a retail CBDC. But as mentioned, all of these are at different stages of work in progress. In fact, if you want to know what is happening in individual country, there is a very good website. This is called the atlanticcouncil.org/CBDC tracker, and it shows you, this is a good website in the sense that they will tell you what is happening in individual countries. Let me show this to you here. So if you just click on any particular country, say Canada, they will tell you what is the current status of CBDC development, what is the use case, wholesale or retail, what is the architecture in Canada, it is the intermediated or two-tiered approach, what is the underlying technology, access, cross-border projects. So this is a very good site in terms of getting to know what is happening in terms of CBDC development in different countries across the world. So that's pretty much all I wanted to talk about. This is a topic which is seeing a lot of traction, a lot of development. There will be there will be developments in terms of technological platforms, in terms of use cases, in terms of design, in terms of implementation. Of course, we have started doing pilot projects, and in coming years, we are going to see much more traction on this. So that's all from my side. Thank you very much. Happy to take any questions or any observations that you might have.
Thank you. Thank you so much for that wonderful, insightful session, Ritesh. So, as always, it has been a long session, so we would love to give you a little breather of like maybe a couple of minutes, which we'll utilize to give a brief background about ourselves, and then we'll take up the Q&A.
Nitish, I can't hear you. Hello.
Am I audible?
Yes, you're audible now.
Yeah. So what I said was like, as always, I mean, it was like a long and wonderful session. So we'll give you a 2 minutes breather, which we'll utilize to give a little background about our institute, and then we'll take up the Q&A. Right. So yeah, to the audience again, before we go into the Q&A, just like to we would love to you already know about us, but still it's the Q&A, and then we'll take up all the questions. Right. So as you all know, I represent Indian Institute of Quantitative Finance, and we as a body, we have been into education and training in the field of quantitative finance, financial engineering, risk management, quantitative algorithming, artificial intelligence, and ML-based courses. And we have been promoting this field for more than a decade now in India. We were founded by pioneers in India and top experts from the field of financial risk management and financial engineering, investment banking. We focus on promoting education and training, as I said, in the field of financial engineering, quantitative finance, risk management, investment banking, algorithmic trading, derivative products, valuations, modeling, artificial intelligence, machine learning, and several other areas of modern finance. Right, and those who are interested in this particular fields of quantitative finance, risk management, algorithmic trading, and all, we have been conducting very comprehensive certificate programs to prepare you for this kind of jobs. And we have few courses which you can consider if you are looking at entering into this field, or if you're already part of the industry, you may also utilize these courses to go more deeper. So I would like to start the list of courses with the certificate program in quantitative finance and risk management, which is a 6 months course, a very comprehensive course which deep dives into both theory and practical modeling for derivative valuations and risk management. Then we have a certificate program in financial engineering, which is a 7 months course. Again, a course in the similar domain, but it's like a course which goes more deeper into the mathematical modeling. So it's a course which deep dive into the theory and practical modeling for derivatives and risk management. Then for those who are interested in algorithmic trading, we have a couple of courses in algorithmic trading. There's a postgraduate program in algorithmic trading, which is a 6 months course, a course which teaches all aspects of algorithmic trading using technical analysis, machine learning, and quant models. There's a shorter course on algorithmic trading for 3 months called Certificate Program in Algorithmic Trading. And this is a course which teaches all aspects of algorithmic trading using technical analysis. Now, all these courses that I talked about, these courses are conducted through live interactive sessions on the weekends through online lectures, where we have like interactive sessions, and you can interact and discuss with the faculty just like you do in any other physical course. And in the actual lectures, though in the webinar, unfortunately, we cannot allow you to speak up because for the large audience, and that's why, like, again, we interact only through the chat window. But in the actual courses, it's a two-way interaction. Whenever a participant have doubt, they can interact and discuss with the faculty. So it's best of both worlds. I mean, you can attend the courses from the comfort of your home or office, wherever you are located on the day of the lecture. You don't have to travel anywhere, but these are interactive. So it's not like a monologue, and you can discuss your doubts during the sessions itself. So very comprehensive courses for people to consider if somebody is interested in these fields. And since all these courses, we use Python quite heavily. So for those who don't know Python, when you join the course, we give you access to a basic program course on like Python programming for finance, which is like a pre-recorded self-learning module, very well designed for people even from non-programming background also to learn the basics of Python and get yourself up to the speed in terms of Python before you start your course lectures. But if somebody is interested in only learning the basics of Python in context of finance and financial applications, they can separately join the Python module as well. It's a self-paced pre-recorded course. Now, it has been a long journey, and we have been fortunate to have a lot of students and professionals who have come out of this program, and they've successfully utilized this to make a very good career. And we have been lucky enough for some of them to share their wonderful experiences. And you may go to our website also to check on like what the different students and professionals feel about this field. But in general, just like the few thoughts that people have shared about the different courses that they have done. Similarly, you may also wish to utilize these courses for making a career in this kind of field. So you may also wish to join. If you are joining these courses, the areas or companies that you can target, maybe like you can start with the international banks like Goldman Sachs, Morgan Stanley, Deutsche Bank, or international commercial banks like JP Morgan, Citibank, Nomura, etc. Of course, hedge funds as well, like Renaissance Technology, DSO, Citadel, etc. Stock exchanges, consulting firms, EY, Deloitte, PwC, IT companies like Accenture, Cognizant, TCS, and all that. And for the kind of profile, I mean, you can see the profiles. You can be into quantitative research and analysis. You can be developing quantitative and analytical softwares. You can be in building valuation models. You can be in the model validation teams, portfolio management teams, portfolio analytics. Of course, in all areas of financial risk, market risk, credit risk, operational risk, liquidity risk, derivative structuring, quant trading, HFT, high frequency trading, other areas of algorithmic trading, derivative trading, and all that. And subsequently, we are coming up. I mean, all these courses that we do, most of them already has like a part which has on modules on machine learning as well. But I mean, in the near future, we are coming up with specialized courses on machine learning for finance. So those who are interested in going into machine learning applications in finance, they can look at that course. Keep track of our website, and you also would receive intimations when that course is launched. So that's another new development that we would like to share. Yes, and it's a long journey. As I said, we have been fortunate to be associated with a lot of financial institutions and other companies for their different aspects. So that's a very small list of some companies which we have been working with. Similarly, there has been like academic institutions also with whom we have worked, like IIT Bombay, BITS, Pilani, NITI, and all that. Right, and yes, in case you wish to contact us to have a discussion, or like again to know more about the courses, our website is iiqf.org, and you may call us on the number provided here, or like other contact numbers in the website. You can email us to info@iiqf.org. So that's about it. And so we'll return to the session, and we'll have the Q&A. We'll take up all the questions that all of you have put up, and we will mostly be taking the questions related to the topic of the day, and post that regarding like questions related to the courses and all. I mean, if we have time, we will take it up during the session towards the end, or else we will get in touch with individually, and like we'll discuss about the courses and any particular questions regarding courses. Okay, so with that, I'll start the Q&A. Just allow me a moment. Right, so the first question is from Amol, and Amol asks, can any individual hold a CBDC? So that's the first question, Ritesh.
Yes, so that is the objective of retail CBDC. Retail CBDC is something which an individual can hold in their digital wallet.
Correct. Right. Okay. That's like, yeah. So now going to the next question. So Murli asks, does this will this include also the cooperative banks?
Sorry, I did not get that.
No, so Murli asks whether this system will also include cooperative banks. So will cooperative banks will also be part of the CBDC when it comes?
So I think they should be in an intermediated two-tier approach. Even right now, cooperative banks, they function like any other commercial bank. They are subject to RBI guidelines. It's just that historically, the deposit insurance that was provided to scheduled commercial banks was not available to cooperative banks, and that's what appeared in the PMC bank crisis. So
Correct.
to answer that, because India is such a large country, I'm sure for the purpose of financial inclusion, cooperative banks serve a very useful purpose in remote areas. So of course, I think they should be included when this becomes available.
Right. Right. So now going to the next question. The question is from Lieutenant Commodore Paramjit Singh, and he asks, is infrastructure for technological change exists to support country? Does the educational level exist to reach every individual? Also a follow-up question. Sir, your opinion on check and balances in fraud that exist. Does India can swiftly check this menace? So these are two questions. You can take it one by one. Yeah.
So to answer your question in terms of availability of technological infrastructure, right now it is not there in any place in the world. So that's why first people did research on whether they want to do it or not. In fact, what I see is till 3-4 years ago, the central banks used to be very, very skeptical about issuing their digital currency at all. If there are only two factors which have changed their opinion in my mind. One was Facebook coming up with a digital currency which could be used for cross-border transactions. And secondly, people have realized that Chinese central bank wants to issue a digital yuan which can be used globally. And that's when the US Fed and everyone said that we cannot allow that to happen. So if you read the statements of Jerome Powell, who is currently the US Fed chairman, till 2018-19, he used to have all kinds of reservations against digital currency or CBDC. And you read his statements from 2019 onwards, and suddenly CBDC seems to be something which can help people deal with a lot of bad things. So that's a change in stance. I think China is, no one wants a digital yuan. The Western countries don't want a digital yuan to become the global currency. So tech infrastructure, of course, would be an issue. There are issues of cybersecurity. There are issues of reach, access. That's work in progress. The point I'm trying to make is we have made a step towards that. It is no longer an academic discussion. It is something which central banks want to do seriously. So I'm sure they will achieve it in due course of time. And the way we have designed our UPI system, it shows that we do have the capability to create the tech infrastructure. As far as fraud is concerned, it's there even today, and still we are functioning. In terms of literacy, if you see, when demonetization happened in 2016 and when people were forced to do digital transactions, everyone said that how can people do this? Indian population does not have literacy and all. But once you force a system upon people, things will happen one way or the other. So they will try to make it user friendly. I'm sure they will try to make user friendly essentially retail CBDC. And even then, retail CBDC will not be the only channel. So you will have physical cash, because it's not possible to eliminate physical cash in India. So recent RBI estimates show that 50% of all transactions in India still happen through physical cash, especially for all transactions which are happening in denominations of less than 500. So we are not a country like Sweden. The reason Sweden is doing so much of research in digital currency, because today in Sweden, if you compare them even to the wealthy European countries in Europe, the percentage of cash as a vis-a-vis the total GDP is like 10-12%. In Sweden, the use of cash as a percentage of GDP has come down to like 1%. So cash has literally gone out. And that was one of the reasons which made the Swedish central bank so worried about a CBDC, because they thought if cash completely goes out, then the central bank does not have any control over monetary policy at all. Everything is in the hands of private players. So India, that's not the case. So what will happen is we will have cash, very much it will be there. We will have the traditional bank infrastructure, bank deposits, and this will slowly come into vogue probably over the next 10 years, 15 years. That's the time horizon. I think it's not going to happen before that. But of course, there's a lot of enthusiasm around this. Let's see how it goes.
Right. Yeah. So now I hope that answers your question, Lieutenant Commander Paramjit ji. The next question is from Vic, and he says, can a CBDC be converted into cash and vice versa?
No. That is the whole purpose. If it can be converted into cash, then why create it in the first place? It will be purely digital. No cash transaction, no cash conversion.
Correct. Right. Next question is from Abdul Hannan, and he asks, how will they manage the price between rupee and CBDC? Will they be same? If not, then how do both of them work together?
Practically, they will be the same. This is like 1 rupee issued by 100 rupee note, either issued by in physical form by RBI or a 100 rupee issued as in the digital form by RBI. So I don't think that RBI will make a difference between the two. But of course, in practical terms, there could be some differences. It's very similar to, suppose you keep a US dollar deposit in London Bank today. Now, the London Bank is not the part of the US dollar clearing system. The US dollar clearing system is in US. So a US dollar deposit in a US bank is not the same as the US dollar deposit in a London bank. They will have different prices.
True.
Because tomorrow, if you want to convert that London bank deposit into physical US dollars have to be arranged in physical form from somewhere. So of course, the bank will charge a commission for that. So there could be market differences around that. But as far as the issuer is concerned, how does the US Fed care where you have stored that US dollar? Similarly, from an RBI perspective, I don't think there would be a different pricing. But yes, from a market participant perspective, commissions and charges could be there.
Right. Right. So next question is, in case we have token-based CBDC, the very essence of CBDC will be lost. Is it the case?
Not really. See, like every other technology or like every other product, every design consideration has its own advantage and disadvantage. Okay, if you want to have, see, for example, the Indian government today wants to make rupee a choice as a global currency. That is also an RBI objective. Now, if you want to make your currency a global currency, which can be used for settlement of international transactions, you cannot have an account-based system, because then how will foreigners transact in that? So if you want to make it a global currency, it has to be a token based. At the same time, you also don't want to make it completely anonymous so that people use it for all sorts of activities. So we will arrive at some form of optimization, I believe. Both the designs have their own advantage, disadvantage. For financial inclusion, the token based system is much more efficient. Even in general, the token based system is much more efficient. It's like I'm having something in my digital wallet. I give it to whomever I want. Why should I want the government to know whom I have given it to?
Correct.
Okay. A pure account based system, and sometimes I think people, especially in India, we don't appreciate these things. There is a huge data privacy challenge. A full 100% government oversight over your transactions is giving an invitation to all kinds of problems, given the state of agencies in most of the countries. So we will arrive at some kind of an optimal design. Let's see how it goes.
Correct. All right. So now going to the next question. CBDCs seem to benefit only government. It will have tighter control on my life. Additionally, I can be robbed by phishing. It requires me to spend on electricity, internet and electronic instrument too. Yeah. So your thoughts on that?
No, not really. See, it won't require any further expenditure. Even today, you have your smartphone, you are charging it, and you have a Paytm wallet or a Google Pay wallet or whatever wallet you have, or your bank account. So a CBDC will be more like that. It's just that today you can go to a bank branch and you can convert your deposit balance into physical banknote. That you will not be able to do. So it will benefit the government in a lot of ways, of course, no doubts about that. It will also have benefits for the people in general. The thing is, you are no longer worried about whether your bank will remain solvent or not. This money is literally risk-free. Okay. Similarly, what people can do with the kind of data that is available, the government can have differential program for different kinds of digital currency, which can be used to provide direct benefit to people. So in terms of efficiency, okay, one of the biggest advantages I see for the retail customer is once it starts getting used for settlement of cross-border transactions. Today, cross-border transactions are such a big mess. The amount of commission that you pay to the banks is huge, and the time that it takes for cross-border transaction. So there are some blockchain-based solutions where you have real-time cross-border transaction settlement. There is a company called Ripple. You can check for them. They have brought in some solutions. But any retail currency which starts getting, because it's a central bank tender, if it starts getting accepted as legal tender for transactions, say even in South Asia, in Bangladesh, in Nepal, in Sri Lanka, if the Indian rupee starts getting accepted, that will be a huge convenience for you. You don't have to exchange it into the local currency wherever you go. It will have benefits for each one of them. It has disadvantages for each one of them also. So that is the challenge for any product, if I can say.
Correct. Absolutely. All right, going to the next question. So Amol asks, as dollar increase, will CBD price will increase in buying? I'm not sure. Did you understand the question?
Say that again.
So he says, as dollar increase, will CBDC price will increase in buying?
No, that is the problem of exchange rates. So just like today
Yeah,
you have a US dollar INR exchange rate, you will have a digital dollar digital INR exchange rate. That's a completely different thing. So this is not an exchange rate problem. What you are saying is, I have a currency which is available in a purely digital format, and one of the strongest ideas behind that is to make your currency an instrument of payment for international transactions. Besides national transactions, you also want to promote it for international transactions. But whatever is the exchange rate, that will be the market determined exchange rate. That is as it is today.
absolutely. Absolutely. Right. So coming to the next question, it's from Naveen, and Naveen asks, will there be any difference between retail CBDC or retail CBDC when it comes to valuation?
Valuation of what? No, I told you, I answered this question earlier. See, in terms of from the RBI perspective, a 100 rupee note, whether it's a physical 100 rupee note or whether it's a digital 100 rupee note, they both are liabilities of RBI to pay 100 rupees, so they have the same value. Of course, from a market perspective, depending on the kind of transactions you are engaging in, the intermediary may charge you different commissions. So the commission for a digital CBDC might be low. The commission for transacting in a physical banknote might be higher. So the market might impose some commissions, but in terms
Correct.
of value, I don't see why they should be different. A 100 rupee note is a 100 rupee note.
Correct. Correct. All right. Going to the next question.
There could be one
sorry,
thing.
yeah.
There could be one thing. So there could be one thing. Today, the RBI, today you don't earn any interest on your cash holding, okay? But because this is a digital money, if you start earning some interest, RBI also start giving you some interest on that digital money, then of course the valuation could be different, because one of them is a non-interest bearing asset, the other will be an interest bearing asset. So that will depend on
Correct.
how it works.
Correct. Correct. So in fact, actually, that probably would be an factor to encourage digital currency as well, because it will earn interest in, I mean, vis-a-vis cash.
I think they will give. I don't know whether they will give it or whether they will not give it, or whether they will only have a negative interest rate on that so that people go and spend. I don't know. It will.
Yeah,
All this is something which is speculation of how it will evolve.
Yeah, yeah, absolutely. Absolutely. All right. So actually, there was a question on that. Will we get interest on digital currency from bank or RBI from Manish? So Manish, I think we have already answered that. It's like something we don't know at this point of time. So this is all.
See, it will come from RBI. It will not come from bank. The reason is this is no longer commercial bank money. This is central bank money. The commercial bank will only become the distributor of that money. They will do the due diligence and KYC, but this is essentially RBI money. So the interest will also come from RBI. Of course, you might get paid. You might be paid that interest through your commercial bank, but it is very different from how you get interest today. Today, you get interest from the commercial bank because you are giving them money to make out loans. So it's commercial bank money, and therefore they are giving interest. This one will have interest from RBI.
True. So the next question is also from Murli. He says that will it bring any changes in currency market to buy and sell other country currency?
In what sense? Forex market. Okay. So I'm not very clear on that, but what I can say is, see, fundamentally speaking, what happens in foreign markets today? For a forex market is all about determining the relative exchange rate of a currency pair based on demand and supply. That will continue to be there whether you are, if tomorrow the entire world goes on a CBDC, so you have a US dollar, a Fed CBDC, you have an RBI CBDC, you will have a digital yuan, you will have a digital euro. They will have their own exchange rates, just like you have exchange rates today. Anywhere in the forex market, the cash transaction is not happening at all. The forex market, except when you go to a money changer to buy, say, $1,000 when you are going abroad, the entire forex market is anyways account based. The wholesale transactions are not happening in cash. So they will continue to have the same supply demand forces apply to the forex markets, and exchange rates will continue to be there. So I don't see any major problem happening there. What can happen is today, say US dollar is the primary choice for transactions across the world. One of the main reasons is because US dollar is completely convertible on the capital account, which most of the countries don't allow. In India, rupee is only partially convertible. In China, yuan is not convertible on the capital account. So if tomorrow digital currency, with advent of digital currencies, things like that change, there could be some impact on exchange rates. because that will become like a safe haven currency. Why is dollar so strong today? Because whenever something wrong happens, people say let's exit all the risky assets and go into dollars, go into treasury securities. So if tomorrow, so for example, when euro was launched, people thought that something similar will happen with euro. Unfortunately, that European experiment did not work. Europe has been busy with their own banking crisis and macroeconomic stability challenges. But if tomorrow there is a global currency and yuan is one which I think has the potential to become in the coming years, then of course there could be an exchange rate implication in the US dollar yuan pair or vis-a-vis other currencies, but that's about it.
True. True. Okay. Ajay says, thanks, Ritesh, for such a knowledgeable and insightful session. Thanks,
Thank you.
Ajay, for your wonderful feedback. Going to the next question. Okay, Manish again asks, will the government accept tax in the form of digital currency? So,
Yes, of course. It's legal tender. See, the basic definition of legal tender is something that can be used to make payment, and the strictest definition of legal tender is what the government accepts as tax. So
yeah,
the very fact that this is central bank issued money, it will be used to pay taxes. Why not?
correct. Absolutely. Rajdeep asks, okay, so this is for me. Do you provide placements for graduates of these courses? Yeah, Rajdeep, absolutely. The idea about all these courses is to prepare you for the specific jobs that I was talking about. And definitely for those who successfully complete the courses, we do have a placement support program for all the courses. Feel free to contact us and we would be happy to guide you and discuss more on that. But going to the next question. Chintan says, can we say with digital currency in use for retail payments, black money could be completely eroded in the future?
It will never be completely eroded at any point of time. See, what happens is that there is I'll tell you, there is a very known law. It's called the Goodhart law. The Goodhart law tells you that whenever the regulatory authority declares something as money, the objective is to better control it. People will come up with some substitution so that they can evade. So it will never happen. Of course, it will become much more difficult, but believe me, human mind is very, very entrepreneurial. People will often always find a way to defeat regulations and government oversight. But of course, to a large extent, it will take care of it. For common people, it will no longer be possible, especially cash-based, because right now the entire black money thing happens through cash-based systems. That will become kind of impossible.
True, true. Okay, so the next question is, okay, now like the questions we will take up a little quickly because we are already post our time, but nonetheless, since there are a few more questions, we would take it up for the next maybe 15 minutes or so. So going to the questions quickly, next one is like, but by what thing the digital currency linked with Aadhaar, PAN card, mobile number, bank account, or anything else? Okay.
Sabhi ke saath, it will be linked with everything. The government now, anyways, knows everything about you. They can link. So, of course, it will be linked to Aadhaar because any account-based system, that will be the identity of the person who is holding that will be the identity of the digital wallet owner. I don't think
Correct.
government is going to allow a system where for high value payments, you can remain anonymous. Then what is the purpose of doing all this? So that would be Aadhaar, probably. And of course, because you will be holding your digital wallet most probably on your smartphone, so they will need your smartphone. So even today in Aadhaar, they need your smartphone number. That's how the validation happens. So that validation infrastructure is in place. They have already done all that groundwork in India. It's only about
Correct.
how to take it to the next level. The problem, the real tech challenge would be that when they implement that system, how do they create the distributed ledger technology? How do they create that ledger? Who will house what part of the ledger? How will they do real-time reconciliation of transactions? See, one basic issue that you have to realize is today, even though you have a blockchain, say a Ethereum blockchain or a Bitcoin blockchain, on a blockchain, transactions get updated only say say 5 minutes, every 5 minutes or every 10 minutes. You cannot have real-time payment system based on that. If you look at a system like a Visa or a MasterCard payment, they are able to do close to hundreds of thousands of transactions every minute. So those would be the technical challenges: how to provide scale, how to provide speed, real-time reconciliation. You don't want to have a system where you have made the payment. See, what happens with cash is you pay 100 rupees to anyone. The transaction is settled there and then. The finality of payment is there. You will want that finality of payment with the retail CBDC. You don't want to be in a situation where you have paid 100 rupees through digital wallet to someone and the finality of payment is not there. Then how will the transaction happen? So building that tech ecosystem will be a challenge. The scale, the sheer scale of that, the cyber security issue, the data privacy issue, and the scale of that and the volume, that would be the real tech endeavor.
Correct. Absolutely right. All right. So going to the next question. Okay, this is from Arul Murugan. It's not a question. He has mentioned, sir, it's a eye-opening session on CBDC. Hope CBDC is a transparent alternative to cryptocurrencies. So that was his statement.
I don't know what you mean by transparency. What I can tell you is there is a lot of negativity about cryptocurrency. People somehow have been made to believe that cryptocurrency is only used by ransomware hackers. It is only used by drug dealers. That is not the case. A lot of that is also propaganda and positioning, where the government wants to have it both ways. What the government is telling to you in India is, you can use it to trade. I will tax you for that, but it is not legal. So the government wants to earn revenue, but they don't want to recognize it as an asset. I think a part of that propaganda is linked to the fact that if you are a central banker, it is a nightmare for you that there could be a decentralized cryptocurrency where you don't know who is the remitter, who got the remittance, and where the units of currency that are in circulation are beyond your control. That is the primary political and central bank issue here. So even if you actually look at hard research of what percentage of cryptocurrency is actually being used for illicit activities, it will be a very small percentage. Of course, some things would have happened, but for that matter, isn't corruption and black money, isn't it happening through cash? But does the government ever want to remove cash? They don't, na? So a lot of it is propaganda. Cryptocurrency is also very good. Government simply does not want to let you have control over your finances. They will never allow.
True. Right. So Gaurav says, thanks for the session. It was very insightful. His query, one query, he asks, will there be more interest earned on CBDC like credit interest earns on commercial banks, savings accounts, or fixed deposit? Will such financial products be launched through CBDC or central bank too, please? Shall I repeat the question?
I got the question. See, you have to understand why the commercial bank is paying you interest on commercial bank deposit. Primarily because there is competition in the market. If it comes to India, before 2012, there was a cap on the interest rate that people could be paid on their savings accounts. Okay, only in 2012 the RBI said that banks can pay whatever they want, and then you had these high interest paying accounts, some of the private sector banks which wanted to increase their CASA or the current account saving account base. Here, I don't know why. I don't think why would RBI want to pay a very high interest rate. They are the monopolist. Only they can issue central bank currency in India, and they are not lending you. It is not for lending. It's a payment mechanism. Okay, so of course they will issue something to you. I'm not saying they will not issue. They may not give you any interest. They might want to give you some interest to incentivize you to adopt it, but it will not be like commercial banks. For commercial banks, these deposits are used as a funding mechanism for their loan business. RBI will not get into loan business. So why will they give you high interest rates?
True. Yeah, absolutely. Right. So going to the next question. So India's CBDCs is blockchain based or any other distributed ledger technology? Any idea on this that you would like to share at this point of
I
time?
think I don't exactly remember. The concept paper has been out very recently in the month of October. In fact, everyone can go to RBI's website and they can download the concept paper that they issued in October. I have not gone through it, but I believe that it will be a blockchain based system like every other place. See, ultimately, uh, the underlying technology is distributed ledger technology. Blockchain is one of the distributed ledger technologies, because the ledger is created in the form of blocks. There are other forms of DLT also, but I believe blockchain is something which financial regulators have now become familiar. So it should be a blockchain based system in India as well, especially because
True.
not only the regulator, even the financial institutions, they have been seeing blockchain based product launches. It's a technology which everyone has become familiar with. So that should be the probable technological platform, a blockchain based one.
Absolutely. Right. So next question is from Srinivasan, and he asks, what will be the difference between current digital currency exchange, Paytm, Google versus CBDC?
Yeah, Paytm, it's the same thing. When you have a money in a Google wallet or a Paytm wallet, that is the liability of Paytm or Google to you. It is not the liability of RBI to you. So suppose you are keeping money in your Paytm wallet, okay, and Paytm goes bust. I'm not specifically talking about Paytm. Any service provider say it goes bust. What happens to you? That they will go into bankruptcy proceeding and you will become like an unsecured creditor. You will come behind the secured creditors with regard to realization of your funding. Now, when it comes to banks, what the RBI says that because they want to maintain financial stability, they are telling you that they have a deposit insurance program wherein up to 5 lakh of deposit is guaranteed by the state.
Correct.
Unlike this, when you go to CBDC, it is directly central bank issued money. There is no question of default on that. Not because the central government is great or the central bank is great. It's because central bank can keep printing money. So whenever you need money, and if they do not have enough money, they will print more and give it to you. The commercial bank cannot do that. So that is why the central bank has to step in at the lender of last resort, where it says that, look, if you don't have enough money at hand or liquidity at hand to pay to your depositors, and all of them are banging at your doorstep, I will come and do it on your behalf, so that people don't lose faith in the system and there is no systemic crisis. The systemic crisis cannot happen with a digital rupee in Indian jurisdiction, because central bank can always keep issuing however much money they want.
Right. Correct. So a repeat question from Lieutenant Commodore Paramjit, and he says, do you see universal wallet?
I don't think so, because no sovereign government would ever surrender their rights to issue currency. Not because of any other reason, it's simply because the government would never let go their control over money. So there is nothing called how can you have a universal wallet? For universal wallet, 180 countries across the world have to agree on something. They have not been able to agree on climate change. How can they agree on universal money? That will never happen. So you will again have a fragmented system. And let's see how it goes about.
Right. Absolutely. Okay. So a little different question from Jigisa, and a continuing question from Radhika as well. So she asked, does the speaker support forcing people solely for benefit of controlling people? Radhika also asked in similar line, do you think citizens of India will be comfortable when it especially for rural people who are not well educated. So I think the second point was like briefly taken up, but for the first point, just let me start by mentioning Jigisa. I mean, the speaker, neither of us is like supporting or against any of the thing. We are just presenting facts. We are not here to advocate CBDC or anything. I mean, it is like we are discussing like both the pros and cons, right? So that is what it is. I mean, we are trying to present it as it is. Yeah, we may have personal opinions, but doesn't matter here. So we are trying to present the facts. Yeah, so would you like to add anything to that, Ritesh?
No,
He asked, does the
I
speaker
think it's not the case where the government is forcing something down people's throat. People also will have a convenience in using this. And when it comes to privacy and all, see, every day we use so many apps on our smartphone where all that data is going to some people and we have no control over the usage of that data. Have we ever complained about it? What are we talking about? I think as long as we are able to get that free coupon, people by and large don't care. That's somehow except in jurisdictions like Europe, where people are very sensitive for over data privacy issues. I do not think, it might sound a bit harsh, I don't think people in India care too much about data privacy as on date. We have much more challenges to grapple with.
Very true. I mean, we give our data for simple apps, which again, sometimes we may even not need.
So, and again, I think to add to that, this will have a lot of benefits for people as well, especially for poor people, illiterate people. It could be used to provide directed support by RBI to different sections of society, to different industries. So, see, like any other technological solution, it will have both sides. Nothing comes for free. There will always be a cost or a trade-off attached. The entire issue is how do you design it to make it optimal?
Absolutely. So as with everything, pros and cons will be there for everything that like mostly that every development that happens. But we are hoping that like the pros will be more than the cons. Right, yeah. So now go ask another question from Abdul Hanan. Won't that create more volatility in the economy because of CBDC?
So yes, I mean, uh, in terms of banking crisis, in terms of a run on banks, I think that's a genuine concern. That today, what happens? The moment you realize that a bank is having a problem, all the depositors go to their ATM or to their branch that please convert this into physical banknote. Similarly, the moment people realize that some bank has a liquidity issue, they may want to convert all their bank deposit into a digital CBDC, and it may be very fast because today you have to physically go to the bank branch or ATM, but at that point of time you will simply be able to click on a button on your smartphone and say that convert my bank deposit into CBDC. So yes, that is a genuine concern. A lot of financial economists and regulators have talked about that. I don't know how they will control it right now because today we don't have a working system in place. It's just a pilot project. Only when the design details are available to you and what checks and balances they are going to use, only then we will be able to comment on that. One thing that can happen is even today the RBI is like the lender of last resort to any commercial bank which is having a run on it. Even in the digital world, they might become a lender of last resort. Who stops them from doing that?
Correct. Okay, now very quickly we'll take like maybe 2-3 questions and then we'll wrap up the session. We are already 25 minutes almost past the timeline. Gaurav asks, sir, you guided about acceleration of bank runs as a disadvantage. Could you please quickly summarize it for me? I was foggy on its meaning.
So it's like whenever there is a rumor in the market, see, banking is a complete trust-based business. So whenever there is a rumor in the market that some bank is undergoing a difficulty, what is the first thing people do? They go to their ATM, they go to their branches and say that please give me my money in cash. That is very similar to what you are going to do even in the digital world. It will be much more faster because now you don't even have to take the hassle of visiting their ATMs or their branches. You just have to go to your bank internet. You use your internet banking, wherein you will have an option to convert your bank deposit into digital currency, CBDC. So if everyone does that, it will accelerate the bank run. That's the point I'm trying to make. That's how the run on bank happens. See, for any bank, if all the depositors together say, or even a significant number of depositors say together that please give me back my money, the bank goes illiquid or the bank goes insolvent. So what the digital realm will do, it will accelerate this entire thing. Just we are already observing that in other facets of the digital world. Rumor mongering, it was much more difficult to have rumor mongering say 50 years ago when there was no internet, but today you can do anything over the internet. So that's what I meant by saying that these kind of issues, these kind of rumor mongering can be much faster in the digital world, and there could be accelerated around the bank. Or what people might say one bank fails, people might lose their faith in the banking system and they will go to every bank and say that convert it into CBDC because that is risk free. So there could be a systemic crisis.
Correct. Absolutely. All right. So next two questions are from Manish. He said that will most of the banks close down? Why would they be required anymore?
No, they will be required because banks will not close down because the economy is so big. They will have a place. Ultimately, if all the banks close down, then who provides credit? RBI. That will not happen. So banks will be there. They will be an important part of the financial system. I don't think the RBI's objective is not to close down banks. They are essentially trying to incentivize people to convert their physical banknotes into digital currency. Of course, it will have second order and side effects, but I don't see banks closing down because of a CBDC. Because see, banks continue to have a very important function. Banks give loans, and actually it is the commercial banks who take the decision over allocation of capital in the economy. If commercial banks are no longer there, would RBI give individual personal loans and corporate loans? They will not. So banks will be very much there. They will be a part of the system.
Correct. All right. So just a couple of questions more from Arpit. He says that is this an attempt to stifle, sabotage, counter crypto? I think we have dwelled upon that before, but he has an additional question. Additional question, and then you can answer them together. Actually, there is a whole narrative on CBDCs are being introduced to gain even more control on your life, and government can use against you to suppress your opinions and restrict you from using your money if you don't agree with the government. So these two questions we have indirectly dealt with earlier also, just like if you want to add anything.
Yeah, so definitely, see, one of the primary reasons is governments do not want a decentralized currency. A Bitcoin is a nightmare for them. They will not let that happen. So do they want to stop crypto? Of course they want to stop crypto. Why would they want to have crypto? Can it be used for government snooping? Can it be used for more government control over your life? It can. If you ask my personal opinion, it can. The example of China is very much there, in which the Chinese government has so much control over individual people's lives. I read in some of the newspapers and magazines that people are given a social score based on who their friends are, how their internet life looks like. That social score can be used to determine whether you get a loan, your job prospects. Is there a danger that the government will have too much oversight in your life? I think there is a very clear danger. in terms of the control that government might be able to have over you. Unfortunately, we are still not having that debate here in this country.
True. True. Right. So I think with that, actually, we have answered like all the questions. Thanks so much once again, Ritesh, for taking up all the questions patiently. And like, I mean, once again, thank you for such a lovely and wonderful, insightful session. Thanks for joining. So with that, I think we can wrap up the session for the day. Thanks everybody for joining, taking your time out on a weekend and being with us for the session. As always, we would be having regular sessions on important topics in different areas of finance through our this deep dive with IIQF expert webinar series. So keep tracking us through all our channels, our website, social media pages, and of course, you will receive intimations for different future webinars as well. Feel free to join any webinar that interests you or any topic that interests you. Always love to have you with us. Thanks, everyone. Thank you once again, Ritesh. And with that, we will close the session for the day. Thank you.
Thank you, everyone. Thank you.
Thank you. Thank you so much.